Hi, I'm Dan Hughes, Managing Director at Hughes and Company. We have an alternatives panel, as Marty mentioned, and what we'll do is we'll do a quick round of introductions and then kind of get into the alternative space and how each of us interacts in that space and as wealth advisors, pretty much across the investment landscape, and the way that we're approaching alternatives as an asset class, which will have a bit of overlap in our previous panel, which is to be expected. A quick bio on myself before we get into it. Obviously, we got Monty, Arun, Rick, and Q. For myself, I'm the Managing Director of Hughes and Company. I'm a introducing broker on the futures side. The way that fits in with the alternatives is that I focus on managed futures as an asset class, and I serve as a broker for those advisors, which are known as CTAs. In addition, I'm CEO of the Futures Crowd, which will be a wealth tech platform to help the wider demographic of investors access managed futures as an asset class. And that's something in development. And what we'll do next is kind of go around the room with introductions. I've got Rick here.
Sure. So I'm Rick Stone. I have my own family office, and I also am the CEO of Palm Beach Investment Research Group, which is a group of 35 family offices. It's structured as a not-for-profit, so no one gets a salary. And what we do is we vet collectively investment ideas across the investment horizon, including hedge funds, venture capital, private equity, one-off deals, middle market lending, multifamily, secondary funds, et cetera. Each investor in the group makes their own investment decision. They don't have to make any investment decision, but when they do, it's their own. But we collectively share the due diligence and evaluation process. We've been in business for 12 years, and we've had about 600 managers during that time period.
Wow, very impressive. Arun?
Sure. Good morning. I'm Arun Kaul with AK Global and the President and Chief Investment Officer. Our firm is focused on outsourced CIO, Chief Investment Officer services for family offices and planners and advisors. A lot of advisors also in the independent channel. My background is on the asset management side, CIO side, both in terms of being on the managers, running a managers platform and a consulting firm for also high net worth individuals. But a $2 billion firm where we help with the structuring of the portfolio and the manager research. And then also on the asset management side in terms of hedge funds and equities. Did a little bit of high frequency trading also back in the day. So pretty broad on the portfolio management side, and also work with a lot of third-party managers and running some long short internally, and then working with third-party managers on the alt space in terms of hedge funds.
Right, perfect. And then Monty, you can hear us. Let's have an introduction for yourself.
Yeah, guys, can you all hear me?
Yep, very well.
Excellent. Hi, this is Monty Agarwal. I'm the CIO and founding partner of Autonomous Capital Management. My background is primarily in the macro asset space in the non-Japan Asia markets, which I've traded for over 20 years. Used to live in Asia. But I have been in Florida for the past 20 years, where I have run my own hedge fund. The strategy that I use is a quantamental strategy, which basically uses the best aspects of machine learning and artificial intelligence, but also combined with my 20 years of trading experience. So sort of provides a roadmap, if you will, for machine learning, so that machine learning doesn't quite go haywire and produce spurious correlations. We have recently also adapted our models in cryptocurrencies, where we trade the top 6 cryptocurrencies by market capitalization as well.
Okay, great. And then Q, if you can wrap us up with an introduction on yourself and a bit of your background.
Nice to join you guys virtually here. I appreciate the conversation about alts, but just a background on me. I'm a serial entrepreneur. I've been in the venture capital business for over 25 years. I've founded Capital Q Ventures with a partner of mine, and actually my son as well, who used to be with Franklin Square Investments. And I led the innovation team to develop a new alternative investment structure called a tri-party venture fund, which invests in sponsored investments from highly vetted, well-established private venture partners. Our first two tri-party venture funds is a fund called Medical Investment Solutions. It's a tri-party venture fund that invests exclusively in sponsored medical real estate. Our second tri-party venture fund is Gallo Specialty Fund. It invests in sponsored global Major League Soccer investments, in particular player acquisitions worldwide. And then we have two non-tri-party venture funds. We have a BDC and we have a hedge fund, National Restaurant Brands, that invests in a diversified portfolio of multi-unit restaurants. I'm certainly glad to be here and look forward to this conversation.
Oh, that's wonderful. Actually, I can lead it off with Rick. If you could give us a little bit of color on the alternative sector specifically. Is there any, what parts of that sector are you involved in mainly outside of your traditional equities and fixed income?
Right. So PVIRG only does alternatives. And I want to sort of just put it in a framework, which is that because interest rates have been low for so long, and because there's been a giant increase in the money supply, some of which is crypto, the availability to invest in alts has been dramatically affected. What's happened is that larger scale investors have gone way down the totem pole in terms of what they're going to invest in. Someone before said Blackstone isn't interested in their $200 million deal. It's not true anymore. There is so much competition for smaller alt opportunities today. We've had people we've invested with for long periods of time that have been bought out by bigger firms, and we've been basically bought out of our positions. So what were traditional high net worth, small institutional spaces have become pure institutional spaces. And the size of the alt funds has gotten larger as a result of that. So the sort of smaller spaces that we had monopoly power in, where it was only high net worth, are not that way anymore. That's sort of my backdrop for that. My second backdrop is I, more than other people, although maybe some people share my point of view, feel that valuations are not just stretched, but we've reached an insane level. That the idea of valuing companies based upon potential revenue as opposed to earnings, which is the major fundamental economic switch in valuation that's occurred between the time that I was in business school and today, is a bad experiment. And I can point to lots of examples, because some of you probably know that I also do securities litigation, and there's never been a better opportunity to be a securities litigator in my life. The number of
venture capital too.
What's that?
Does it apply to venture capital?
Yes.
How do you assess the valuation of the venture capital if there are no revenues?
That's the question you have to ask before you invest. No, I don't have to answer that question, because I wouldn't do that. I
So
would.
you don't invest, your group.
I mean, there are
doesn't do
revenue,
venture-
and you're talking about. Well, let me come back to that.
Yeah, litigation finance, you've got a certain amount of niche players.
No, I'm not talking about litigation finance. I'm talking about your general group. If you're saying that you cannot value companies that do not have revenues.
No, I didn't say that. I said you can. I don't think that valuing companies based solely upon a multiple of revenues is a sensible methodology, although it's been accepted on Wall Street.
I see.
I actually want to throw it over to Monty here. Monty, you had mentioned an alternative space that you're in that is definitely not going to be more commonplace, but definitely a niche with what Autonomous does. Can you kind of go over the area of alternatives that you kind of operate in?
Yes. So as I said, I have basically been involved in the non-Japan Asia markets. A lot of unique factors about the non-Japan Asia markets. One, and those unique factors basically lead to the fact that my strategy has a very fixed capacity of about $1 billion. And that is a function of the fact that the markets are not as liquid, both in terms of volume as well as instruments that are available, as there would be in the G7 markets. Now, that is good and bad. Good in the sense that because those markets are less traversed by the large multi-strat hedge funds, what we find is that the signal to noise ratio is higher in the non-Japan Asia macro markets than your typical G7 markets. So that makes data mining and using AI a little bit more profitable than it would in the traditional G7 markets. But at the same time, the opportunity set is small. So it's not like that we can manage $10 billion in that space. Now that obviously will change as these markets evolve, and they are at a pretty rapid pace. But those are sort of the two contravening aspects of the markets that we operate in.
Okay. So as I understand it, you're mainly on the currency side and kind of more of the macro manager yourself, kind of specialized in that field specifically with the Asian environment, correct?
Yes, the currencies and interest rates.
Okay.
And obviously with what's going on with the inflation, the pickup in inflation, we're seeing pretty volatile moves in the long end of the curve. Also, Asian markets have been probably the first to start hiking interest rates. I mean, you've seen South Korea, New Zealand, Australia, and even Singapore recently tighten their monetary policies. So the volatility is definitely higher in those markets, without a doubt.
And then, what do you see as the global macro climate going into 2022 as kind of a key kind of theme that you might be seeing here in tandem with that?
Right. So inflation is real. And it's interesting, I'm watching Powell's testimony at the Senate right now on Capitol Hill, and he has removed the word transitory from his speech on inflation. So yes, I mean, we look at the 4 pillars of inflation, and deglobalization and wage inflation is definitely not transitory. We're starting to see number prints, pretty scary inflation data prints, not just in the US, but around the globe. And eventually that takes its toll on the central bank chiefs. So I think the biggest risk for 2022 is we will see tightening monetary as well as fiscal policies. Now, if you take a look at what has driven the equity markets over the last 2 years, has been fiscal spending and QE. So both the numerator and the denominator of the typical equity valuation equation have been affected by that. Now, with elections in the US next year and inflation a true concern, I think you will have both fiscal and monetary constraints come in. So you will see, in our opinion, you will see sharp bouts of volatility in the markets. And given the overcrowding, and not just in the traditional space, but even in the hedge fund space, I think that will play a critical role in what happens in 2022. And by the way, on the cryptocurrency side, we are very bullish from a beta perspective. I think volatility is here, but also we're looking for much higher moves in at least the top 6 cryptocurrencies by market cap.
And that kind of is a good question that can lead into outlining the risks that we see in the global landscape. Where do you see a lot of the opportunities where, coming from your perspective on the currency side, what are you seeing as those opportunities for 2022?
Yeah, so obviously I am biased towards data science, the use of data science in investment decisions. We are starting to see a change in the market behavior, where in the past you would see sharp market reactions to actual data prints. But now what we are seeing is that the markets tend to react in anticipation of those data prints. And when the data actually prints, the markets go the other way. A good example of it was the move in the oil prices last week. We have been seeing oil prices trending down on speculation that oil would be released from the SPR. But the day that it was announced, oil prices actually moved up. And the reason for that is that high frequency data is being mined, not just in oil, but across several asset classes. And hedge funds are reacting to that. So if you are not using AI in your investment decisions, then you will be a step behind. And that is an evolving field, but we see the most growth and the most opportunity in the AI ML subset of investing decisions.
Okay, perfect. Arun, this is a perfect segue into kind of what you do. Which area of alternatives are you mainly operating?
Well, I'll pull back and maybe address it from the topic of asset allocation and portfolio design. So really in the backdrop that we're in, where we've lost cash and bonds as an asset class effectively, where you can't get the return or you cannot outpace inflation. And the question really becomes, what component of your portfolio do you need to add? Is it return? Is it income? Or is it some kind of downside protection? So on the alt space, we're looking specifically to address one of those areas in terms of either having some kind of income that you cannot get from markets or inflation that's above the rate of inflation. So alternative credit is certainly one area that fits into that. Real estate obviously is another area that fits into that. And then downside protection in terms of a meaningfully different level of beta versus your equity market beta. So if you're in public or private equity markets, you still have an equity beta. It's a fairly high correlation. So we're looking for something that's on the downside in terms of protection, a managed beta, or some kind of risk offset to the equity markets, or something else that's going to actually give you diversification in the portfolio. So right now, the correlations amongst the asset classes are much higher. Everything is being supported by effectively a distorted 10-year interest rate, 10-year level of interest rates. So we see the underlying structure just being much less stable. All of it's tied to lower rates, which to Rick's comment on valuations, when you don't have rates, you don't have valuations either. So you can make any argument you want about valuations when there is no competition.
Zero denominator.
Well, yeah. So if you take a look at Rivian and you're paying, it's $100 billion company with no sales. Well, that's very difficult to explain or recommend that to a client from a fiduciary perspective and say, well, you should buy this stock for this reason because it has phenomenal growth, or it's going to take total addressable market is what's the arguments being used now to kind of look through that. So on the alt side, what we're really looking for is something that's going to offset some of what we can't do in a traditional portfolio, or something that's going to give us downside protection, true downside protection, not random hedging. So long short with a controlled beta or option strategies with puts that can actually give you some kind of downside protection.
That's a good question. So when would you say as a wealth advisor, alts, primarily deploying from risk reward perspective or absolute return perspective or diversification? How does that?
Yeah, so we really, and the word alts, I've never been a fan of that word because it just has no meaning. So everything is alternative today. So you can go to crypto and go, that's alternative. So we've actually replaced that with the word risk offset. So it actually has the perspective to offset risk in your portfolio. So if something, and this again is our definition, so you can define these in many ways, but if it's truly risk offsetting, which typically is your equity, your beta exposure, then it makes sense in the risk offset category, which is usually an absolute return or a lower beta strategy or something that can give you some kind of a hedge or some kind of beta mitigation. So that would kind of be the biggest bucket. And then income would be more alternative sources of income, which can be non-traditional fixed income, if you will, or maybe bank lending or some form of lending that arguably has a big opportunity as well. So we kind of place it that way.
Where, when you redefine alt in the way you just described it, where does correlation play? So non-correlation,
right?
Lack of correlation relative to risk seeking assets.
Yeah, so that's the most important definition of risk offset. So risk offset by definition must be non-correlated, and that's usually from a lower level of beta or a specific risk budget. So if you sit down and say, well, you're running a long short equity fund or market neutral, but you have a risk budget of 6 or 7%, then you have a very high confidence level that you be non-correlated. Or if your beta is 0.3 or 0.4 or 0.5, a majority of the time, not our long short fund is 0 sometimes, or 90% net long, where your beta is going to vary. So the correlation is a component of the definition of how we define risk offset.
But all of that depends on your timeline. Sure.
Correct. Yes.
And so so do you advise clients on an individual basis according to their own timeline?
Yes.
I guess that's a good question of how does AK investment typically work as a business?
So the timeline is critical, and the the market hold in the market today is about 9 months for a stock. Right, so if you're in the stock market, on average, this float turns over every 9 months. So the time investment horizon is critical to the individual client profile. And then the risk offset is going to be a little bit longer hold depending on what asset you're in because they're liquid, right? You can't get out of them. They're not as liquid. Obviously, their assets are liquid, so your time frame can be a little faster. And we actually have a separate bucket that's opportunistic, that's meant to really go into those opportunities that are, I think, faster opportunities in today's market, that are a little higher velocity, but have good return potential. So you can get a lot of high return, but it's a little higher velocity trading.
It's a sad state of affairs when you realize that the whole world is holding stocks at 9 months.
Well, that's the
I mean,
average trade, right?
What happened? What
Well-
happened to fundamental, equity investing?
They don't count when cash is, when capital is free, right? You don't have your basis. And if rates are negative, then how do you explain negative rates to anybody? Like, I still can't explain that to anyone. Well, your rate is negative on your interest rate.
Yeah, coming from the managed futures component, something that really didn't catch too much attention prior to COVID was negative correlation. I mean, we have a lot of advisors that will come in at the angle of non-correlation, and during COVID, you would see that non-correlation doesn't mean that they all can't perform the same way in a crisis event. Negative correlated advisors, specifically tail risk advisors, is something that I caught on that investors definitely developed more of an appetite towards adding to their portfolio to then overall lower their net exposure. So that's something I've seen on my side. Q, to bring you into the conversation here, with what Capital Q does, will non-correlation to bonds and equities be even more important moving forward here?
Yeah, to add to this conversation, I think it's important to understand that there's a whole private sector marketplace that doesn't have the same beta risk exposure. And so what we do with our tri-party venture funds is to qualify as a sponsor, you have to be in business 25 years. You have to have a consistent business model that has been performing over 10 years. And so what ends up happening is our sponsors have been in business so long that they've gone through all the economic cycles, and because they're private companies and they're not trading on the markets, and they have less beta exposure. And I think that's an important element when you're developing a portfolio, is that you have not only less non-correlated assets, but you have a basis that is going to weather those storms a little bit better. And so, for instance, our venture partner with our Gallo fund, they've been in business since 1908. It's a soccer club in Brazil, and they've done player transactions worldwide at every economic cycle. And I think it's important to note that those transactions are not going to change whether the fixed incomes are down or whether the stock market is highly volatile. And I think that's an important note for any family office when they're looking at their portfolio, that they have some basis that is non-correlated.
And tri-party venture funds, real quick, for those that might not be familiar, what do you mean by that?
So basically, we've done an investment structure that actually contracts with the sub-advisor. And so in like Medical Investment Solutions, our investment sponsor is a company called Daniel Corporation. They've been doing medical facilities since 1977. And so the fact of the matter is we will only take projects that they bring in, and so we spend a lot of time in doing a vetting process to qualify our venture partner, but all the projects are vetted through that third party. And so now we have not only us as a general partner, but our limited partners, but we have a venture partner that is an added element to bring in more stability to our portfolio. And from our standpoint, the two that we've been doing are giving us a solid return, and we do not expect, even in a market downcline, any changes to our portfolio.
Okay. Now, do you see any disruption in the private fund, kind of alternative structures that exist, or what are your thoughts on that?
Yeah. So
has anything changed from an infrastructure perspective?
Our idea when we first, started building these tri-party venture funds, where we were seeing a lot of companies remaining private for a much longer duration, staying in the private markets from inception to when they were going public. And many companies were opting not to go public or not having that liquidity event, but they were still needing the cash continue to grow their companies. So doing a sidecar fund in conjunction with these private companies was a way that we were decentralizing their funding. Companies need funding; they're always going to need funding. But in the scope of what we're doing is we're establishing a funding mechanism to keep those companies and allow them to remain public for the duration, but taking their funding operations out to the market and giving institutional investment returns to their funding operation.
Okay. And then Q, can you explain why your alternative funds, might keep repeating this risk-adjusted above market returns? You had some comments on that specifically as well.
Yeah. So what we're noticing is everybody says the same mantra, risk-adjusted returns, but nobody really builds in all the inherent risk to investments, especially in the venture capital side. And as we're seeing more ESG projects and lower returns for these ESG projects, they're not building in all the true risk associated with that investment. And so when we say risk adjusted, we consider all internal risks, including market risk and including execution risk and things like that. And I think what's happening is everybody's using the same language, but they're not absolutely disclosing what the inherent risk to all the investment is and how that is adjusting those returns, or that the alpha and beta to all the investments. And I think it's important for a good portfolio manager to sit down with their investors and actually fully disclose the risks, even non-apparent risk. And we're seeing a lot of stuff that's happening in crypto and blockchain and NFT right now, and everybody's jumping on a bandwagon, but I don't think anybody's really explaining the inherent risk to these type of investments. And I think it's critical that we have these conversations.
Here's a good question. A lot of people say that COVID kind of sparked a K-shaped recovery where certain sectors obviously benefited more so than others. From here, let's just say, what part of the alternative landscape, what sectors are you positioned for, or that you really advocate for?
Yeah,
so will do well from here on out.
Yeah, I think it's interesting because let's just use real estate, commercial real estate as a sector. Obviously, everybody is weary of commercial. Restaurants are not in favor. There are a lot of sectors that are non-favorable. And a lot of the REITs are turning to funding mechanisms, but that's a short-term life. What we did when we did obviously the medical real estate is we took a sector and said, let's identify a sector that hasn't been harmed. And Southeast United States real estate has been growing exponentially, but more than that is we found that sector is performing at a higher rate than most other commercial real estate sectors. And so I think you'll see that as we move forward, as we start to decentralize. I think the ETFs from a decentralized basis are going to be a scary proposition, and I think we're going to see some resets in the ETFs, and I think there is going to be a mobilization into more alts because, and frankly, I don't like the term alts myself, but I think what you're going to see is you're going to see more and more money leaving the various ETFs and moving into alts, because I think it's a safer proposition.
Definitely with ETFs gaining so much popularity, their effect on the market itself is definitely extreme. With the duration risk that we've got now, especially with the treasury landscape, Rick, where do you see as kind of a sector that you've really been looking at? How are you kind of positioning yourself? How are you looking at fixed income? Are you replacing it? Are you putting something in lieu of fixed income, but maintaining a portfolio of fixed income? Or what are you mainly doing?
I would say most people in our group never had a fixed income portfolio. They traded bonds, but they didn't have a fixed income portfolio per se. But the areas we're looking at now are carbon credits, secondary funds, multifamily, and some middle market lending. Carbon credits, there's several ways you can go at it. There are ETFs, there are funds, and then there's futures. But it's not without risk. I mean, the California carbon credit market has been a 90% performer this year, but it was down 11% in 2 days in the fear about Omicron. So when people say things aren't correlated, in my opinion, it's generally nonsense. Everything's correlated on the downside. When you suck liquidity out of an infinite liquidity machine, the merry-go-round stops and people fall off. That's just a fact of life that people have to accept. And as someone said, are we in the 7th or the 8th or the 9th or overtime in the baseball game? I don't know. If I did, I wouldn't be here. I'd be much richer and I wouldn't have to deal with Marty. But no, but we're somewhere near that. And from the opinion of a private investor, not someone who's selling a product, the street's been reckless here, and it will come back in a much bigger way than 2008, which was the mortgage market itself. And people will look back and say, how did we do that? But the issue we have is, what's the way out? When you take the air out of that system and you stop funding SoFi, I owned SoFi for 8 years. During that 8 years, as a bank, they lost over $1 billion. How'd they stay in business? They issued more equity. So my equity got diluted 90% during that time period. And then, of course, they SPAC. There wasn't a SPAC that size at the time that they started the company, but SPACs became popular, as we all know. And so my original investment should have been worth 16 times what I paid, but was actually only earned 3 times what I paid due to the dilution that I suffered. Then they came public, the stock traded up. They continue to lose money, more money they did when they were a private company. Will that be a turnaround? It may be, but it's been a decade-long fintech, the fintech darling of Wall Street, I might say. And for 10 years, they've lost a lot of money. And banking isn't biotech, and banking isn't medical tech. Banking is banking. So they're the poster child for fintech, and the road to profitability seems far off still. And there are not 10.
It's kind of it's a company version of inflation of its its trading value, and people are mesmerized by the stipulated numbers, stock price, etc. But buying value essentially of the stock has become extremely vaporized. Essentially,
it's a representation of companies trading on revenue and not income, and how long that can happen when interest rates are zero and there's infinite liquidity. How long can a company like that exist? In a normal market, not very long, but in this market, 10 years is not a problem. And
if governments are complicit.
They're not specifically complicit in this company, but they're complicit in the lower interest rate environment and infinite liquidity market, right?
A central bank practice.
Correct.
On the second,
I grew up in Zimbabwe. Okay.
Oh, wow.
We're getting there.
Right.
So I mean,
You have one of those $1 billion Zimbabwe notes.
I have
Right?
a $5 billion. And when it was issued, when the Zim dollar was first promulgated in 1980 something, it was 1-to-1 to the dollar. Now that 5 billion, when I got it in about 2010, is worth $2.
Right.
And so it goes.
So Monty and Michael were discussing the value of we're heading towards Zimbabwe or not.
$10 billion.
We're trading $10 billion Zimbabwe bulls right now here at the table.
on Rick, on the secondary funds market, where are you seeing are you getting a lot of deal flow that comes your way, or what are you seeing?
We invest with managers. It's still a strong market. I think it may become stronger. There's certain tax changes that may make people with IRAs and 401ks sell their secondaries. And it's become a very liquid market. People now see the opportunity in what was a restricted market that you had to hold for 5, 7, 9, 11 years to get out at 90% of value. For some people in an appreciated fund, that makes a lot of sense. So it's actually got a functional purpose of adding liquidity to a restricted market. We think that continues. There's a lot of insiders with a very inflated stock that's public that won out. And the secondary funds also do that. And that's become a big part of the secondary fund business. Multifamily real estate in Florida is still hot. There's a shortage because of the number of people moving here. I live in Jupiter Island and I can see 4 developments went up on US 1 in empty lots in the last year and a half. Dense multifamily. These are 2-story units. And then West Palm Beach is probably the biggest multifamily growth in the country. Not only are they building in the main part of West Palm Beach, which has become a little bit of a financial corridor into West Palm Beach, but they're building in the way outskirts of West Palm Beach that are sketchy neighborhoods and charging $2,200, $2,500 a month for single bedroom rentals that are 600 square feet.
It's gonna become like Miami, where they name like Calle Ocho, they renamed Brickell West. They're gonna call Lake Worth West Palm Beach South.
There's an empty office park across from the airport in West Palm Beach that had vacancy of like 10%. That's going all multifamily.
So what danger do you think there is of a collapse in this kind of hyper growth real estate?
I think Florida, I do think the super high end of the market will collapse. The prices in Palm Beach and related areas are higher than New York City now, prime New York City. Right now, Palm Beach, except for Monaco, is the most expensive real estate market in the world. And 6,000 a square foot is not at all absurd in Palm Beach. Oceanfront, 7,000, 8,000 a square foot. There's very little oceanfront for sale. But in the center of Palm Beach, you're talking 3,000 a square foot for a house that needs work. So the market there is literally the highest in the world, except for Monaco. The multifamily is a different thing. It is a fact that people are escaping New York, New Jersey, and high tax jurisdictions. How long will that continue? Will there be tax change? Will SALT change? I don't know, but that is a demographic phenomena that's been accelerated a lot by COVID. And people are willing, I see these people and I question them, are willing to overpay to get out of New York. Even though there's very little high-end housing for sale outside of Palm Beach, like Palm Beach Gardens and those areas like that, people are willing to bid up properties 10 or 20%, even above asking price. It seems like a ridiculous economic decision, but their justification is, I want out of New York. I don't want to pay taxes in New York. I don't want to risk a state tax in New York, and I'm going to make this decision now. So this herd mentality, I don't think it's very different than people buying Tesla or Rivian. I'm one of the people that just bought the new electric Mercedes. It's the greatest car I've ever seen. Forget it's $100,000. Mercedes always underprices their S-Class cars because they're going to build a whole series of other cars on it. Goes 0 to 60 in 5 seconds, 400-mile range, beautiful, luxurious, just like a Mercedes. And guess what? They have a dealership network. I know that's a rare concept, but when your car breaks, there's a place to go, and there's 4 of them within 50 miles of here. Right. So does that mean that Mercedes should now be worth $200 billion? No, it doesn't. But Tesla and Rivian are mispriced. And there will be a day of reckoning. The thing is, Wall Street just makes believe there won't be a day of reckoning, or the day of reckoning will be after they retire, so they don't care. As I've said to my group, I think 20 years from now, people will look back and say the villains of this period of time were private equity and the central bankers. They have conspired to take companies that they know will never be profitable, that their business models are losers, and push them to go public. And the incredible thing is, from a securities litigation point of view, many people are selling out in the IPO, unheard of until 2000. That would never have happened in the 80s or 90s. I'm suing a company right now. The insiders made $1 billion a piece on a company that has never made a penny, never will make a penny, and in all likelihood will go bankrupt. So we're in a completely different rules-off environment. On many levels, not just interest rates, not just instant liquidity, not just new money called Bitcoin, called crypto, but the rules have changed.
And
private equity
statements that cover these investments are ineffectual.
You're talking about in SPACs.
I got a good point with that. Something that we saw from COVID also that developed is a change in regulations, specifically with Reg A, Reg A+, Reg CF. What that did was that created actually access to alternatives. Specifically by that, I mean real estate, art, wine. You've seen products that come out, and anybody can answer this question, Does anyone have a thought on, Yield Street, Seed Invest, Crowd Fund, VinoVest? Have these helped the market? Are these sources of potential identification of opportunity? Or, what are our thoughts on that? Has anybody utilized those here?
So I'll just comment on part of that, and that's just to your comments on private equity and correlations, and kind of come back to that part. But the big issue on the design side is that, and I'll push back on the earlier comment about private equity being non-correlated. It's fully correlated, but you have a timing difference because it's illiquid. So you're taking short-term stock market movements and correlating them with a 5-year hold. Well, that's not really valid. Now, if you're illiquid and you don't need the cash, then that's okay. You can argue, well, I don't need the cash, I don't need the liquidity. But if you own a private business and it's a hotel, or you own the Hilton publicly, it's the same industry, it's the same business. You can't argue your private equity holding is uncorrelated to a public market holding. But you do have a timing difference or an illiquidity difference or a mark to myself as opposed to mark to market. So that's a legitimate issue because the correlations are much higher. And what's happening is that the push on the private equity or the venture side on valuations is moving into stocks, in the sense that Rivian is the ultimate example of a company that makes no sense on the public valuation side. It makes Tesla at 140 times earnings look reasonably valued. So this disconnect, or this kind of connect, is only going to grow as you have bigger secondary markets and as you have more active secondary offerings, because you're going to have more frequent trading in the secondary market of private equity. So to me, the correlations are much higher. In our framework, private equity sits right inside the equity bucket because it's equity. Now there's a difference in timing and liquidity, which is another issue to manage. But if you have we have a client or a potential client that is a little under $10 million net worth, but they have a significant amount in real estate. They don't have enough liquid net worth to retire, which they want to live off an income stream, because even on $3 million liquid, that's only about $150,000 of cash flow, 5%, which is not that easy to get in the public market. So they're wealthy, but they're not that rich that they can just take what they have now that's liquid, even though they have a fair amount of wealth, and they can't get out of the real estate funds because there's still some gating. So to me, those issues are really significant at the family level for planning, because the correlations are much higher than we're looking at them. And they're all predicated, to your comment, they're all predicated on the cost of money being mispriced. And it's the 10-year that's mispriced. It wasn't mispriced in 08 and 09. Cash was, but the 10-year bond wasn't. So the longer term lending was much more stable because the 10-year was at least above the rate of inflation. And we don't have that today. So we have both cash and the 10-year mispriced, which means that everything, even though they're good ideas, the crowdfunding, they're all good ideas, but there's too much cash at the wrong price coming in. And that's really the risk. That affects every asset class.
Yeah, I definitely see that there's a concept of chasing yield, especially with that duration risk that's out there now.
Well, you can't find it. And to your comments earlier about ESG, if you want yield today, you're going to buy tobacco, you're going to buy fossil fuels, and you're going to buy drug companies. That's where the yield is. And if you have an ESG portfolio, yeah, and if you can't buy those companies for whatever reason, then you can't get any income. There is no income in the public market. There's very little income in the public market. And MLPs, pipelines.
Are you guys doing crypto borrowing schemes or things like that? Or I mean, there's a lot of stuff out there that provides liquidity, but it's crypto based. There's like ways to trade crypto where you're borrowing it, and there's a lot of
yield farming has definitely become very popular. I've seen from my perspective, traditional advisors that have taken their expertise specifically in trading futures or trading traditional financial markets and have moved to the alternatives landscape on that DeFi world. And obviously it's more the Wild West than even the futures landscape, where you've got questions yet to be answered on regulation. You've got questions regarding safety of funds. You've got education that's not fully out there. So you're definitely going to see, and we've seen people move to that world, because obviously with that high implied volatility, that's kind of what derives a lot of potential for profit. In addition, that the products have these characteristics that don't exist in the traditional world, where there's rewards for actually participating in the beginning. That's something I personally really don't have too much knowledge in. But Q, you had mentioned a couple of things. What are your thoughts on some of this?
So, I and I understand there's a disagreement at the table with regard to all markets that are affected by you know, a downturn in any in the equities markets. But the reality is and at least what we're trying to do is we're trying to stabilize those holdings in the private markets to where I can tell you in the loans we make to medical real estate, those loans are not going to change over the next 10 years, no matter what the market's going to do. Now, we will have some, as rates are increased and interest rates change, we will have some exposure to risk with regard to inflationary risk. But from our standpoint, we feel like we're a stabilization factor. And albeit there is some correlations to the interest rate risk, we feel that we are establishing kind of a baseline of what our performance is going to be over the short term and intermediate term.
Okay.
I have a very interesting fund that I run into. It just, and I've been trying to share with Goodwin, who's ignoring me. But the company is called Global Public Offering Fund. So it's a high liquidity venture capital fund, and they're so what's happened in the venture capital space is that everything is segmenting. And to get to, I think maybe it was Arun who brought it up on crowdfunding, or maybe you brought up crowdfunding. A lot of VCs won't invest in crowdfunded companies, right? They don't want to be involved with something that has, 500 LPs, right? So they're number one. Number two, a lot of VCs will not have it in their work. They won't take companies public outside the US, right? So we're sitting here in an environment where there's 3 to 4 unicorns printed a day, right, in the world, right? 50% of them are in the United States. Let's say 1 or 2 companies go public.
More than 50% of the United States.
Right, and a lot of them go public, but not as many. I mean, it's like a long line of going public. It's probably like the decacorns who are going public, right? So it's very difficult. So this fund has come up with a list of all of those, unicorns and semi-unicorns, and they're investing in all of them. And as long as they agree to go public somewhere else in the world, Australia is a huge consumer of American companies want to go public. And so it's very fast liquidity. They've got a 12 to 36 month horizon on liquidity. And to me, it's a very interesting play on the venture market, which has notoriously been long-term, same thing with private equity, right?
What's the name of that?
Yeah, that fund is called Global Public Offering Fund. There's a guy in New York who's running it. They're growing rapidly.
Hold it for 9 months.
And I think and their whole point is to get in on, so fintech is a great example, right? There's a lot of fintech unicorns, but there's probably 50 times more fintech companies that are worth $100 million, right? And in Australia, you can take a $50 million company valuation public, right? And there's been a lot of US fintech companies that have gone public in Australia only to relist on the US stock exchange once they get to unicorn status. So it's very fascinating. It's just another play on the venture markets. It's faster liquidity. You're not stuck in something that's opaque for 10 years.
Is it a private fund or an ETF? What, how's it?
They, I believe, are annual funded. So they raise a fund every year, So that's one point of view. The other thing is that there's a lot of VC firms in Silicon Valley. So we've had like more than 500 VC firms present to our group, and probably 200 in the last 3 years. Probably 150 of them are micro VCs. And so I think a lot of the practitioners in Silicon Valley are very different from, like, let's say New York, where a lot of people are steeped in Wall Street perspective, whereas practitioners in Silicon Valley are more likely to be oriented towards branding and the brand space and the ability to create brand, right? So, and to me, valuation, we talked about intangible value yesterday, and there's tremendous intangible value. I mean, if you look at a lot of these fintech companies or other, SaaS companies, they don't own any assets, right? They've got all their servers are on Amazon, they've got code, some IP, et cetera, and that's it, right? And they've got 50 people in the US and 300 people in India, right? And so it's very possible to get in with a lot of the micro VCs in Silicon Valley as an LP, where they're willing to give you 5 to 10x co-investment, which is phenomenal, right? So I'm not sure who's playing a commercial. Okay, thank you.
Marty, you point out one thing, and I'll do my final comment because I think the one thing that's not focused on is that the unicorn phenomena and the high multiple phenomena and the 10 times revenue model is almost entirely US based. We did an analysis for our group that showed the market move from 2008 till now, and then during COVID. And basically the US has been double the rest of the market movement of the world to triple in the NASDAQ. So Europe has had a move, but nothing, a third of what the United States has if you combine NASDAQ and S&P stocks. And the multiples in the US are so much higher, even though they have the same interest rate environment in Europe and Asia, that when that event occurs, it's going to be much more US centric, the downside.
The downside.
What changed?
But you think on the private side as well?
I think it's going to be both private and public.
It's almost as if government or the feds, or the Federal Reserve, are desperately afraid of altering, the supply, because they know that a slight change, will cause a sort of almost catastrophic psychological reversion.
It's the question.
Actually, there's a
going.
ton of political reasons for the Fed policy. There's a lot of political reasons,
There
not
are.
many economic
Whatever
reasons,
the reason.
but political, like velocity. We didn't ask about velocity of money, which is like slowed to almost negative, right? So, I mean, there's a lot of issues from a macro point of view that we haven't discussed, but they're very real. The political issue, number one, is that I think is that the public pension funds, there's a trust fund that's supposed to be insurance. It's like $50 to $100 billion. That's supposed to be the insurance for trillions of dollars of pension funds, and they're all radically underfunded. They all assume, actuarial return on investment of 7%, so they have to do it with their equities. Nobody here has talked about 60-40, equity versus bond splits, but you're not getting anything with that 40% anymore. So, those are all big macro questions that people have to really address.
Yeah.
And
I think Arun had a good thought and wanted to give him an opportunity for closing remarks from the board, but specifically for the 60-40 with the alternatives. But
Sure.
go
So
ahead.
just on 60-40, so we've really taken the 40 away. So effectively, it's 60 and then anything but the 40 that can kind of give us some income. So it might be real estate or what we would just call even hybrid income. So you can get now access to preferreds, or you can do bank loans. There's a lot of vehicles that are ETFs that are not fixed income that generate income, but you have to take more risk. So you have to step out on the risk curve and have some equity beta that you don't have with bonds. So bonds are useful on a day like last Friday and assume today, although I haven't seen the curve, but rates were down. So other than today and Friday, you get some risk offset in your portfolio, but you're not making any money in bonds. So it helps offset Friday's risk in your balanced portfolio, but you're still making zero or negative returns in bonds. So that 40 is down to maybe 20, or maybe even 10, depending on the portfolio. And there's a substitute of income, which might be hybrid income or real estate. And then what we would actually call an inflation hedge, which is something that can offset inflation, which could include crypto, but also would include inflation or other assets that have some kind of hard asset backing. So that's kind of how we've kind of looked at the 40. So it's just can't put someone in bonds. The bonds we have are all under 10-year duration, so 5-year, kind of 3, 4, 5-year ladders.
Would you put dividend growing
Yeah.
equities, defensive stocks? in
Yes.
that bucket as well?
Yeah. So in the hybrid income, we have those high yield names, and that's where you're going to get back to tobacco, pipelines, drugs, and some fast food, McDonald's, and some. They don't have big dividends. There's some that are around 3. There's some of the private equity funds have larger dividends, so they actually look reasonable as well. I would argue the publicly traded private equity firms are a good place to be if you want private equity, because they actually look fairly good.
interesting.
As opposed to the direct private equity investments, given some of the valuations.
Interesting.
Monty, do you have some closing thoughts?
Yeah, a couple of points on what you guys have been talking about. One, what Rick said, that a look back at when all this party ends, there'll be 2 villains, central banks and private equity. I'll add a third to that, and that will be the fiscal spending done by the governments. Because when the money is spent, be it in any form or fashion, it all ends up in corporate balance sheets. And that is probably one of the main reasons why crypto has come around, because it's been just too much money and not enough stores of value for that money. So that's the factors. Second, on the correlation, we believe that correlation benefits don't quite come from asset classes, because in times of risk on or risk off, that correlation goes to extremes. But correlation benefits actually come from strategies. The ability of strategies to switch from momentum to mean reversion rather quickly based on changing market environments. So you might see correlation benefits 90% of the time, but when they actually are needed, they tend to disappear if you're only relying on assets for creating a balanced portfolio.
And Q, some closing thoughts from you?
You know, I think I would add one villain to the list, and I would say the myriad of new ETFs and the strange structures in the ETF markets are really pushing the envelope with what I think most folks, accepted as what was the normal of the ETF marketplace. I think it's gone a little bit haywire, and I think you're going to see a lot of litigation in that side as well. But I would add that one villain, and frankly, from a safety standpoint, I still would argue that that what we're doing with the private markets is creating a safety network for our LPs, and we're seeing, over the term, we feel very comfortable moving forward with with the products we're offering these tri-party venture funds.
Yeah, I definitely have seen, the private markets being opened, not only through the advent of technology, the different ways in which, accredited investors can come in prior to IPOs. Alternatives definitely makes a case for when you have equities at this valuation of the different options one has. And I would say anyone that family office that wants to follow up with anybody here on the panel, obviously can reach out to Marty and get some more color if we want to continue the conversation. If anyone else has any further questions.
There were a couple of questions on crypto, but I told them to wait to the crypto panel.
Okay, yeah, we got a crypto panel coming in later today, and I want to say thank you to everybody here on this panel today, and thank you, Marty.